to today's webinar on unique non-QM loan structures, close more loans by structuring winning deals. So as questions come up, please go ahead and use the little questions tool and I will ask the speakers on your behalf. I am going to be sending all of you a copy of the slide deck. So don't worry about taking notes. You will have the slide deck about an hour after the webinar is done. With that, I'd like to turn it over to today's speakers. Take it away, Tanner.
Thank you, Rose. My name is Tanner Williams. I'm a regional manager here with LendSure. Looking forward to sharing some unique structuring that we can do on some of our loans.
My name's Tyson. I'm an account executive here at LendSure. Also really excited to be with you guys and talk through structures and helping you guys close more deals.
Tyson. I am Catherine. I'm an account executive as well here with LendSure, and I'm very grateful to have the opportunity to be here with us today. So thank you all.
All right, so I want to kick things off here, just talking to a couple of points. You know, I think a topic like this deserves a little bit of an introduction, explanation of what we're actually doing, because a lot of you guys on the call are probably veteran loan officers. You probably structured, you know, hundreds of loans. You know what you're doing in that regard. So, you know, we're really talking about some of the more unique things that we can do as LendSure, specifically as a non-QM lender, that maybe you haven't ran across before or haven't thought about. Where if you are, you know, taking a loan in-house or trying to do something through, you know, like a UWM or somebody that's just, you know, not kind of focused on non-QM like we are, then some things can slip through the cracks and they may tell you, hey, your loan doesn't qualify, when really we can get it qualified. Just takes a little bit more of you know, subject matter expert on that can, you know, really look at it. So there's a couple things to think about. One is qualifying, right? Structuring loans when we have issues qualifying, and so that can be creativity either on the income front or on the debt front to fix your DTI. It can also be using interest only to lower the qualifying payments, right? Qualifying off of that lower starting interest only payment. And then it can also just be borrower preference, right? Maybe you qualify just fine, but the borrower's like, I have certain things that I want and that I'm requiring essentially regarding the prepayment penalty, you know, maybe rate, maybe cash flow, you know, monthly payment versus the rent that you're bringing in, could be fees, right? Could be cash to close. So, you know, a lot of different things that you'll come across that, you know, we have some options here that we'll talk about that can help you in getting these deals structured in a way that everybody wants to move forward with it. So just a little bit about us, a little resume. We're closing about 600 million a quarter right now. That's exclusively non-QM business. So when I say we're subject matter experts and it's all we do, you know, myself and the account executives on the call, as well as the rest of the company, you know, we eat, sleep, breathe, live non-QM every day. So we're able to help you guys, you know, in a way that a lot of other companies can't. We are the #1 non-QM broker option for 5 of the top mortgage bankers in the nation, and we're in a close second place for a 6th. So we, you know, this is our niche. We're very good at what we do. It's something that, you know, you guys are going to find really probably in just one loan that you send our way. You're going to be able to, you know, feel the difference. We are an industry leader in exceptions granted. It's probably the #1 reason we are the top 5 or the top lender for 5 of the 10 mortgage bankers in the nation. You know, it's something that we take great pride in, and, you know, something that our management team is really crucial in providing that, right? So from the top down, our lending philosophy comes from people with, you know, dozens of years of experience in the industry. And so when we're able to grant exceptions, we're able to do it because our AEs have been trained up knowing, hey, this is what we like. This is what we think is a good loan or a bad loan, regardless of whether or not it meets guidelines, right? We like to joke that, you know, we don't really even look at guidelines here. We look at, do we like the loan? And then we're lending in all 50 states. So a little bit outdated on the chart there. North and South Dakota we're in, Vermont we're in, and then New York we're still investment properties only at the moment.
Yeah, so kind of to kick things off and shift a little bit into specific programs, I want to start us with DSCR loans. I think intrinsically, Tanner mentioned, you know, we're closing $600 million in non-QM loans a quarter. I would expect that everyone on this call has seen a massive rise in non-QM products, and DSCR is one of the biggest ones. DSCR used to be the epitome of a niche loan that not a lot of people did. And now I hear from everyone, hey, we're doing DSCR loans. They're becoming more and more popular. And I think one of the most important things that I could give you is, this call isn't intended to teach you how DSCR works. That's not what I want to do. More than that, I want to give you an example of a tool that you can use to help win more deals with more clients. And so ultimately, when I think about investor clients today, what it is that they're looking for, they're looking for some combination of a few factors. And I've kind of got that on the screen. Ultimately, they want simple pricing that's obviously competitive. They want a deal that they can look at and be excited about the interest rate, be excited about the cost, but they want to be able to understand that. They want minimal closing costs from a title perspective, and really what they want is to be able to maximize the cash that they have in their pocket to renovate this property that they're buying, to float it if they're trying to get a tenant in there, to stage it if they're short-term renting it. That they want minimal closing costs to fulfill all of those goals. Then they want to close really, really fast. They want high speed. And with those top three items, I tell you, for the most part, a DSCR program is really tailored to hit all of those, right? But as we expand a little bit, investors are starting to want a little bit more. They're looking for loans without a prepayment penalty. They expect that rates are going to drop at some point, and they want the flexibility to get out of the loan. And they want to do all of this with no points. When I think about this list of 5 items that most investors are looking at, it's almost like a meme that I think of, where you're trying to click 3 buttons and have all of them checked at the same time and check every box. And when you check 2 of them and you go to check the third, one of the others is unchecked. Maybe you have a lender that has great pricing, but they're not fast. Or maybe you have a lender who's extremely fast, but they can't check the pricing box. And more than that, they require a prepayment penalty. So what I really want to introduce here is what we're calling the no prepay, no point DSCR loan. And ultimately on this next slide, I have an example for you guys built out of really kind of what that looks like. So on the left-hand side, you'll see a traditional DSCR loan, ultimately something that you could get from almost anywhere. You're doing a loan at a $500,000 loan amount. This lender's likely using a standard prepayment penalty, which lasts for 3 years at a 5% cost. Ultimately, they're charging, borrower paid comp at origination. So you're charging points. You're charging 2 points at origination. Oftentimes, they're not offering a lender credit. And ultimately, what this does for the borrower, if they paid off the loan before that prepayment penalty is over, not only are they paying all these origination costs, covering title costs to get this off the ground, but they have a potential cost of a $25,000 prepayment penalty. And their potential total costs between paying you at the front and paying the prepay is $35,000. And so what a lot of lenders are doing now is they're trying to give you the option to allow the borrower to buy out of a prepayment penalty. And so for a very similar loan, they can do this with no prepay, but the cost of that is paying points at the front. And the terminology I'd use here that some of these other lenders are using is, hey, we're going to buy out the prepayment penalty. We're going to buy out the risk of an EPO. So ultimately, not only are you charging points to get paid, that BPC that you can see, the lender is also charging points to buy out of this prepayment penalty. They're still not really giving a lender credit, and you're looking at a loan where you have to sell the borrower on paying $20,000 to originate this loan, in this example, between buying out the prepayment penalty and paying you. But then also, essentially they've got this upfront cost, and I apologize. I should have updated that chart a little bit better. What I really wanted to build to, and I guess the biggest thing that I would highlight here, is an option that we have, which is no prepay and no points. And really the crux of this idea here is to build in flexibility for your client to allow them to pay the loan off early with minimal closing costs. What we've rolled out is an option to decrease the cost of that prepayment penalty. Essentially, what we slap on it is a 5-year term at 1% cost. And then what we do is we build in your compensation into the interest rate. We also build in a lender credit to the loan. And so your investor can look at this and compare apples to apples and say, okay, on one hand, I have a loan with a 3-year prepayment penalty, 5% cost. And on the other hand, I'm looking at this loan option where essentially I have no upfront costs whatsoever. Compensation for the loan officer is covered by the interest rate. And LendSure is also building in a $5,000 lender credit to their other closing costs, to their title costs. If this borrower pays the loan off early within that 5-year prepayment period, instead of hitting them with a tertiary prepayment fee, they're merely paying back the lender credit that we gave them at the beginning. So you can look at them and honestly say, hey, we're not charging you points on the front. We're going to build in a lender credit. And if you pay the loan off early, all you're doing is paying the lender credit back. That's all that's changing.
Yeah, absolutely. Thank you, Tyson.
Thank you
Catherine, I
guys.
think, okay.
Yep. Alrighty. So I'm gonna cover 2 options that we have here, and then kind of explain how we can combine those 2 options.
Catherine, I'm so sorry, but there's an issue with you keep fading in and out. I'm wondering if you unplug your headset and just use the computer audio, that might help.
Yeah, I can test that out.
Sorry, everybody.
Can anyone hear me?
Speak really loudly.
Can you guys hear me?
Yes.
Okay, perfect. Alrighty. We are going to go over a quick couple of structures here. We're going to see how we can combine them and try to get you guys some cash flowing options for your potential investors. So first topic I want to cover here is going to be 1040 interest only option. So can we get the next bullet point here? Alrighty, starting off, just a brief breakdown. We're going to have 10 years of IO payments followed by a standard 30-year amortization. Now we do have options for, a 10 and 20-year fixed, 5 and 25. Just contact your local account executive if you want some different options for that. Biggest thing with going interest only is that we can still make payments towards the principal balance. So that's a question we get from a lot of our investors oftentimes. Wondering if, possibly if they sell a different property, if they can take some of those funds, pay down the balance here. So that is an option with interest only. Biggest thing that we'll want to make sure of is the prepays that Tyson was talking about on our last slides. The way that it works at LendSure is that you just want to make sure they're not paying down more than 20% of that principal balance. So getting into where this can be beneficial for our DSCR investors, specifically is that we can actually qualify with their DSCR score utilizing the interest only payment. So if we take a look at the table down below, we have $1,500,000 loan amount across the board. The initial rate we quoted out for a 30-year fixed was 7 1/4. That put our payment at $10,200. Now, an instance where you may have an issue with this, say the rents only come back at like $10,000, you're technically not cash flowing at this point. So we would have the option to flip to interest only. You're going to see a little increase in the rate there of 1/4, but as you can see, monthly payment drops by about $900. So that's $900 back in your investor's pocket that, in the last example, we were actually at a loss. Last piece here is interest only with rate buy down. Now in this example, we have them buying the rate down to 6.99%. Typically costs about a point, depends on, all those different break-even points and discount points. But in this example, we'll say it costs $1,500. And as you can see in the first example, the 30-year fix versus interest only with buying the rate down, you're saving $1,500 a month. So you're paying $1,500 one time up front, but then you're filling your pockets back up all the months after to continue.
And I think, sorry, Kat, if I can, I was just going to say something that I think, from a lender perspective that we think about a lot is, hey, how do we make the ratios work, right? From an investor perspective, one of the most impactful, I guess, scenarios that I've had We had a DSCR loan that we were trying to do, and we couldn't make it work with a fully amortized payment. I got on a call with the loan officer and the borrower, and we talked through his options, and I presented interest only. The loan officer wasn't in love with it, but we talked about it with the borrower. The borrower was over the moon, and his exact words were, "Why didn't you guys start with this? I would have preferred this. You're telling me I can save," in his case, it was about $350 a month. And so I think something to highlight interest only, I think there's a connotation there to say, interest only, I don't know. What I love about it is it's a fixed rate, and it lowers their payment to help them cash flow, which should be their goal.
Exactly. And then just small thing to build on top of that, with you going with the 1040 option, in the case that they do hold the loan right through past the 10th year into the fixed options, you are spreading those payments a little bit thinner as well. So you are also helping with the monthly cash flow there. Small story of where that actually helped me out recently saving a deal. I work in a lot of new build communities for DSCR purchases because typically the builders aren't offering DSCR options. So with that being said, a lot of new builds, when you start the loan, taxes are still based off of just the assessed land or the lot or things like that. So our tax figures are much lower. You kind of get down the line, you get the appraisal back, maybe the 1004D back, and then escrow sends back that actually fully developed tax cert, and boom, my ratio went negative. Investor was cash flowing, and then all of a sudden they're not, just because of our taxes came back. In this instance, we were able to just quickly flip to just interest only, get the ratio back over, and we had a happy investor, and we were able to proceed with closing there. So just a small instance of where this would be applicable for you. Alrighty, we're going to get into a unique structure to LendSure mortgage. We call it stacking. It's essentially financing points into the term of the loan. So essentially, we can stack both compensation and discount points into the term of your loan without affecting the par rate. So if anyone's familiar with any VA loans, it's very similar to the VA funding fee, where we can kind of just build those points into their monthly payment. And again, the main emphasis here is that we're not affecting the par rate. So just a small example of where this could be beneficial. Same instance from before, $1.5 million loan. You're charging 2 points as a loan officer, borrower paid compensation, but we're going to stack it into the loan. So with that being said, the borrower saved $30,000 at the closing table that they would have had to liquidate from, say, a stock account in order to meet, the proper cash to close here. Alrighty. Now, to develop off of both of the topics that I did just cover, we're going to go over some rate buy down with stacking to show just one more option we can present to borrowers if we ever need.
Catherine, Carolyn has a question. What difference does it make in their monthly payment?
So it depends on loan size, right? And it depends how much the points equate to. But typically we're seeing an increase between $50 to $150 a month. So nothing too bad. And specifically for investors, I always say, why would you want to pay those points up front when you can have your property's revenue pay for it in itself? So we'll kind of develop a little bit further and show how that can work a little bit farther here with this idea.
I'll add on that real quick too and say, if you're talking about doing like BPC, like let's say 2 points BPC, and stacking that in, and what impact that has on your payment by increasing your loan amount a little bit, versus doing 2 points LPC and raising the rate, in both cases, you would have a reduction in your cash to close, right? In one case, the points are getting financed in the loan amount. In the other case, the points are basically being built into the rate, right? So your cash to close is the same in both cases, but your monthly payment is vastly different. To Catherine's point, you're only looking at a minor increase when you increase your loan size. But if you were to jump that rate up a full percent, then that's a pretty significant increase on your monthly payment. So specifically in LPC versus BPC, BPC with stacking is always going to be way better on the monthly payment. Then you start looking at, and we'll look at this in a second here with this next grid, you start looking at, oh, well, okay, my payment goes up $100 or $150 because I'm stacking, but what if I then also stack some rate buy down? Well, then my payment actually goes down because although I am increasing my loan size, I am decreasing my rate, and so that overall is going to actually lower the payment, not increase the payment. So we'll look at that example here in just a sec.
Alrighty, just a brief overview here. What is rate buy down with stacking? So essentially, like I covered on the last slide, we can apply discount points towards the loan to help buy the rate down. And we can finance that into the term of the loan. So essentially, we could be moving up into the next LTV bucket, say from 65 to 67%. And with that being said, we would not change pricing at all. Pricing would remain the same there. Biggest benefit here is when we're trying to figure out those ratios. I think that this is really beneficial in finding the lowest possible payment for your borrower while they're still cash flowing, kind of see the most that they can get out of their revenue from the property. And like Tanner kind of just covered, reduction of an interest rate is going to be very beneficial to our borrower with both incredible savings over the life of the loan, as well as lowering their monthly payment. As we know in today's interest rate market, monthly payments are growing as they are. So we're just trying to find every solution that we possibly can to help bring those down. Alrighty, so we're gonna get into an example here. So this is the same scenario that we talked about a couple slides back. Same $1.5 million loan amount, 75 LTV at 7.25, just par pricing. Same payment there for this illustration. We have taxes and insurance at $2,400. But in this instance, you can see that our property is only renting for $12,000 a month. So we're at about a $600 loss per month to our owner. So DSCR score is at 0.95. With the DSCR and going IO, now the main difference here, rate goes up 1/4, term is for 40 years versus 30. But as you can see, payment significantly decreases, and now we are suddenly cash flowing. Last topic to really tie these all together is when we are going to apply discount points and compensation points and stack both of those into the term of our loan. We can see the results here. So in this instance, we did change the VPC. We have a 1.5 points borrower paid compensation, as well as 1.25 discount points to take us from 7.5 to 6.75. Therefore, we have a total of 2.75 points in our loan amount. And so as you can see the difference in the LTVs there, we're jumping from 75 to 77%, but there's no internal rate adders or anything like that for doing so. With that, as you can see, monthly payment, significantly decreases. Your monthly savings are about $1,500 a month, and you're increasing your cash flow by an incremental amount here.
Yeah, so you've heard of the term "have your cake and eat it too," right? That's kind of what we're trying to do here. Is you get the benefit of reducing your cash to close, all those points get financed into the loan amount, and then you would think with a higher loan amount that your payment would go up, but the payment actually goes down when you factor in the fact that we're buying down the rate. Using some of those finance points.
Awesome. So moving on to kind of the next topic we want to discuss with you guys. We want to talk about bank statement loans. We do them, but similar to the theme that we've kind of had with this, we want to go at a high level of how you guys can make your bank statement loan offerings to your clients just so much more dynamic than what it is that you're doing right now. And so ultimately, where I always like to start with this is, what's the problem with the bank statement loan that we have today? What are we trying to diagnose? And I think ultimately, with any and every bank statement loan that is evaluated by any lender across the board, expenses on that business are going to come into play. I know this may be shocking. Every business that I know of has an expense that they have to pay. So how is your lender evaluating those expenses? It is a question that I think is paramount to this conversation. And I really think that it can make or break a deal. Now, vastly from everyone that I've talked to, lenders I've worked with, loan officers I've talked to and interviewed to try and understand how other people are doing this a little bit more, I understand that expense factors broadly are going to do different things everywhere. Some underwriters prefer a fixed expense factor. I'm sure you guys have heard of the 50% expense factor, where they just cut 50% of the deposits away. Others are going to have it vary, but the common theme that I hear most consistently is that in 9 cases out of 10, you were tasked with the condition that says, hey, we need a CPA letter validating a lower expense factor. So go ask their CPA to tell me that, you know, this, I'm going to use a real estate agent as an example because I think it's relevant and really easy to comprehend. You know, my underwriter says that this realtor, you know, we're using a 50% expense factor. So you go get a CPA letter to prove that they're not. And the intrinsic problem with this is that the CPA is the person who filed the tax returns that is causing this borrower to go the bank statement route anyway. What CPA is going to contradict themselves? It doesn't make sense. And I call out the realtors because I know for a fact that there's not a realtor in this country, on this planet, who's paying 50% of their income to run their business. And so what I really like about LendSure's approach, and what I'll introduce here, is our approach to expenses. It is extremely simple. I let the business do the talking. We don't require a CPA letter to fill in the gaps of expense report. You can see a form on your screen. It's called a self-employment questionnaire. What we do is we take this questionnaire, I send it to you. I can help you talk to the borrower or ask these questions if they need help to understand what it is that we're asking. But ultimately, the borrower's filling this out to tell us about their business instead of my underwriter telling them that 50% of their revenue is going back into the business. It's really simple. Ultimately, I'm looking to underwrite the business. And what I tell you guys to kind of add a caveat here with this is I obviously can't just take this with a grain of salt. One example that I like to use because I think it's relevant, we were working with a contractor. So as he filled out this questionnaire, he told us, hey, you know, I go into homes, I do a bunch of work, I build cabinets, I do flooring, I do all this stuff. And we were like, awesome. And on the questionnaire, he told us that he had $0 in expenses, no payroll, he had no rent, he had no overhead. And we said, okay, that's awesome if that's true. But we also have the bank statements. And so we're not going line item through every single thing, but we can see pretty easily, I think it was something like 1,000 transactions at Home Depot that this contractor did within the last year. And to us, we said, hey, you know, that looks like it might be an expense. Can we come together and find, you know, like find the happy medium? So what I like to add with a caveat is, look, I can't just take this form blindly and say, oh, well, that's what it is. But I will tell you, I can't emphasize enough that our underwriters are looking at this form, and we're not asking for a CPA to get involved here, because the CPA just filed a tax return that caused the borrower to need to use a bank statement loan. And I think when I'm talking to you guys through this, like there's so many applications. My favorite one that we closed in the last couple months was for someone who drove on Uber and Lyft and DoorDash. He was a driver. He delivered things. I think we can all agree that this person is more than likely not spending 50% of his income to drive for Uber or for Lyft. There's no payroll, there's no overhead. So we pre-approved his loan as a first-time home buyer with a 15% expense factor without a need for a CPA to be involved. We just had him fill out the form.
Alrighty. Thanks, Tyson. Another awesome thing about the bank statements here with LendSure is that account executives are very happy to take a look at the income up front as well. With bank statements, sometimes it takes a little bit to get there. So if you do have any things sitting on your desk right now, I know that the account executives are always happy to take an initial look and see where we can move forward from there and kind of see what a digestible payment would be for the borrower if they're in the shopping process. Moving on from bank statements, I think everyone knows about asset depletion. It's pretty standard. As we all know, you know, Fannie and Freddie depletes over 360 months to start, and in their most aggressive cases, they deplete over 240 months. Main difference here with LendSure is that we start depleting over 120 months. That's our most conservative approach. We get more aggressive. We go down to 60 months depletion, and then, you know, we have some options to entertain some other options, but those are evaluated on a case-by-case basis. We accept multiple types of assets, of course, liquid, stocks and bonds at about 80%, retirement at 70%. If they are of retirement age, we do qualify them at 80% for that. And then I will get into this on the next slide here. We can use 80% or 50% of crypto assets as well. Big points here and main differences that set us apart. Don't need to be of retirement age, so absolutely no age requirement. an instance where I had this come to me instead of going the typical Fannie Freddie route was I had a borrower who was 30 years old, had a large trust inheritance. He didn't have a current job. And of course, a lot of underwriters would question why is someone in their 30s not having a job. But we brought it over here and we were able to see that, I mean, the kid has a $12 million trust account. He could buy the house himself a couple times over and over again. So we were able to deplete over 120 months and easily close the loan there. Big thing as well, you don't need to liquidate funds when we're using it for asset depletion. So you can continue to build wealth in those investment accounts. And then one small piece here is that we actually can start depleting assets as supplemental income starting at $200,000 total post-closing costs. If we are going to use 100% asset depletion, though, we do ask to see $500,000 in the account post-closing as well. Alrighty, starting off with a topic that is growing, I believe, in the market at the moment, crypto. So essentially, if your borrower uses a company like Robinhood or Coinbase, they're going to be able to receive a monthly statement like we would see from Chase Bank or Wells Fargo, something similar along those lines. And the main piece there is that we're going to want to be able to verify that the assets are in fact owned by our borrower. So that's the main thing that we're looking for there. If we can do so, we can use crypto for reserves at 80%. And then we could actually use it as well for income with asset depletion, but we do, put a 50% usage factor on there to mitigate some risk. And then same thing with the 120-month draw schedule.
So I guess to jump in here maybe a little bit, if I can, if that's okay, Kat.
Yeah, of course.
I was lucky enough, or not, I'm excited to share that I just closed an asset depletion loan using cryptocurrency as our asset base. And what I think was really cool about this, and what I want you guys to take away from this, is that borrowers still don't know that we can do this. The whole genesis of this particular borrower wanting to buy a home was that he heard the news that Fannie and Freddie would consider accepting cryptocurrency as a reserve fund. And so ultimately, I don't know if you guys knew that or saw that, but to him, to this borrower, he said, "Oh, well, surely that means I can qualify for a home." He has $40 million in cryptocurrency. That was kind of his takeaway. So to him, he was like, "Well, I have 40 million. I see the news that I can use crypto for reserves." And as professionals, you all know reserves and income are not the same thing. It landed on my desk, and ultimately this borrower doesn't have a job. He has 40 million in crypto. So we did exactly what Kat said. We verified the assets. We used 50% of them. After his closing costs, he had $125,000 of monthly income that we could use to qualify him to go buy a house. He's been renting for the past 5 years with $40 million in his pocket because he didn't want to liquidate it. And I really think the takeaway here is that there are so many borrowers who don't know that this is something they can consider. They can do this. The other cool thing about this is once we closed this loan, the loan officer that we were working with had 4 other borrowers lined up to do something similar. Because these I'm going to use the term crypto bros, these crypto people talk. It's a massive network of people who are not used to doing things the traditional way, who don't want to liquidate their crypto to use it. And the beauty of this is that we don't have to liquidate their funds.
And the other thing I'll add too is, this doesn't just apply to the people with the, 20 million, 30 million, 40 million, right? As Kat said earlier, we can use this as supplemental income. So I've had a couple cases now where, our DTI is at 55%, 60%, and we end up asking, some questions and going back and saying, now, at the beginning of this process, we asked, hey, what's your total asset position, right? What do you have in assets altogether across the board? And for whatever reason, as Tyson mentioned, when we ask that question, we still have like 50% of borrowers that don't mention their crypto. They're like, oh, I can't use that. That's not, they don't even bring it up. And so you really got to dig in and peel back that top layer and say, no, including crypto, what is your total asset position? Because we're able to take, some $400,000 or $500,000 in cryptocurrency and deplete from that in order to get our, ratio in line, right? Our DTI in line. So, these are people that are not just the mega millionaires, right? You got plenty of others that are also investing in crypto and can use that towards their income calculations as supplemental income.
Alrighty, last kind of piece here with asset depletion. This is pretty niche, but we do want to present it as an option for helping to save a couple more deals for us. So essentially, one of our most popular programs is the Boost Bridge program, where we do the bridge and purchase loan. So in this example, the best example is going to be for a retired couple, retired borrowers, I would assume. People who have built up a lot of equity in their home, only have retirement income, and so you may be struggling a little bit on qualifying for the DTI on the purchase loan just due to that retirement income. And so with that being said, if there is extra equity available in the departing home, we could take excess cash out on the bridge loan to use as supplemental income utilizing asset depletion. So if I can make up a story here, we would say my retired borrowers have 100K post-closing costs before we do any of this. DTI is currently at like 52%. And so I'm just wondering, what can I pull out? What can I do to solve this problem? I could go up to the max LTV on the bridge loan because we were a little bit lower before, take out some more equity, and now my borrower all of a sudden has $200,000 in assets post-closing costs. And you may be thinking, typically you can't take more cash out to help with a DTI problem because it's essentially going to be a net wash, may even put you in more of a negative light. But the benefit with doing the bridge and purchase loan here at LendSure is that we don't hit for the debt of the departing residents when qualifying on that new purchase loan. So with increasing the loan size on the departing, we're not going to have a change in our DTI because we're not factoring in that monthly payment here.
Okay. So I want to talk a little bit. This is a niche, and I'm a little bit of an underwriting nerd. So I get really excited about this. I'm going to try to put you guys in a frame of mind that hopefully gets you guys excited about this too. I want you to think of the last big investor client that you worked with. And ideally, I guess kind of what I'm targeting here is that this person probably owns 3 or 4 investment properties, and now they're trying to purchase a primary residence. So going DSCR isn't really an option. It is, let me be more clear, it isn't an option, right? But this person has 4 or 5 or 6 mortgage liabilities that you're tasked with qualifying them for a new house with. And that's really kind of what I want to talk about. How does LendSure look at real estate income with respect to DTI? And it's really pretty simple. What we're doing, which completely differs from the conventional model, is we're taking whatever the losses are. And Rose, sorry, if you could bump to the next slide, I apologize. We essentially are not going to treat it as a full liability. That's the answer. I'm not necessarily looking to get 1007s or things like that. We're going to take however that property is performing, and we're going to subtract the losses from the borrower's verified income elsewhere. And so what I really want you guys to think of, this is a phenomenal way for you to maximize purchase power, to get your borrower pre-qualified or qualified for the biggest loan possible. Because ultimately, this traditional income calculation doesn't do a great job of showing how they're actually performing, how their properties are actually working for them. Rose, if we could bump to the next one, please.
Yeah, I'd draw a quick comparison to, like we did on stacking to VA funding fees, right? Similar thing here. Think of how you treat alimony, right? Alimony doesn't go into your debt column alongside, a car payment or credit card payments. Alimony just reduces your income. And that's the same type of thing that we're doing with the REO schedules. We're reducing the income, not treating it as a debt.
Yeah, no, thank you, Tanner. That's an awesome way to conceptualize it. So a scenario that I'll kind of walk through. I'm big on stories and kind of talking about that. I'm going to highlight this second bullet point that's on the screen for you guys, that Zillow rents can be used on a departing residence. A loan that we closed, or that I closed last year, was for a borrower moving from New York to Florida. His intention was to take his departing property that he was leaving and rent it out. That's all he wanted to do. Well, when they tried to go conventional, he was required to either get a tenant in place and verify a lease, or order an appraisal on this departing property and get a 1007. He needed to close fast, didn't have time to wait for 2 appraisals, one on the purchase and one on the house he was leaving. So ultimately what we did and what we can do is use Zillow rents with this method to offset the payment on a departing residence. I think of this as the perfect solution for your borrowers with multiple investment properties, or maybe borrowers where DTI is just, it's a little bit tight and you can't quite get it done. This next slide is one that I look at as probably the most extreme example I've ever seen of this method in practice. But I'll kind of paint the story for you guys. We had a first-time investor. This person owned a property free and clear. They had next to no liabilities on the front end. Front end DTI was really, really low for these folks. They wanted to go purchase a new investment property. To this person's name, they had 20% down. It was a $1.3 million purchase. They possessed enough funds to put 20% down and cover closing costs, not a penny more. So oftentimes I think there's a stigma where we're talking about like an investment property where you'll call a lender, you'll say, hey, they can do 20%. And the lender will say, cool, we might need more than that. Well, what happens when there isn't more? And that's really where I want to take this. So ultimately, this person, you'll see kind of with the traditional DTI method, what would typically happen is you guys would take the rent that they can earn on this investment property and add it to their W-2 income. Their W-2 income was about $7,800, and from every place that we could find to try to project rents when we were pre-approving them, the most we could possibly get in rents for this property was about $5,000. The payment on the property was $8,000. So that's a losing recipe. Ultimately, when you add up all their income, it came to about $11,600 traditionally, and their total debts with this new payment were about $9,000. So that's pretty easy math for a seasoned loan officer to look at and say, well, 83% DTI, I can't do that. So most loan officers would do what mine did. She called me and said, Tyson, I have a DSCR loan for you. They can rent it for $5,000 and the payment is $8,100. To which I said, hey, a 0.61 ratio. I can do that, but I can't do that at 80% LTV. I don't have anywhere to put that. Can they put more down? To which, yeah, you guys have heard that before. To which the answer was, hey, no, they really can't. So I did something that the loan officer thought was really unconventional. I asked for income. This was a W-2 borrower making, again, $7,800 a month. We verified that and we put this into practice. And what we did is we took the $5,000 in rents and we subtracted the losses that they were, essentially the payment that they were going to incur on this property. So every month, this borrower was going to lose $4,800 on this property, to own this property. Instead of hitting for that as a liability, we subtracted it from their income. So their new income that we can use is $3,850. With our front-end DTI, they've been diligent, they've paid a property off, they own it free and clear. They have $1,600 in front-end liabilities, meaning we could qualify this person to buy a property with a payment of $8,000 when they only made $7,800. And again, I highlight this as an extreme example. This is not the norm, but I would encourage you to apply this kind of mindset and this practice to your borrowers where DTI is maybe 52%, but they own 2, 3, 4 investment properties. And you just can't make the math work. The math doesn't math, for lack of a better term. I can't express how exciting this little option is, this niche is, to be able to qualify them for more. On top of that, for borrowers who are transitioning or moving from property to property, Kat talked earlier about the bridge loan. Rose, could you move to the next slide really quick? I'm not going to do a deep dive on our bridge loan. If you have questions, please call your AE. But ultimately, we have 2 ways to consider that departing residence, just to underscore that Zillow point. If your borrower intends to retain the property, we can use Zillow rents to help offset your DTI with this methodology. On the other hand, if your borrower intends to sell, we have an awesome bridge loan.
Yeah, one thing I'll add on that, thank you, Tyson, is a lot of loan officers don't think about or don't realize how many full doc loans we do where it's not like, an issue with the property. Like, for example, a condo hotel. Yeah, that would be a reason you would go non-QM even if you're full doc, right? But outside of a property issue or a credit issue, most people would say, well, they're full doc, so non-QM is not going to be any different. Why would I consider non-QM? And really the DTI piece of things and how we look at X, Y, and Z item, and this is a deep well. I mean, there's dozens of things that I could talk about, from part-time income and seasoning on note income and all kinds of different things where, we're able to get more aggressive full doc than what Fannie Freddie will do. And so, the amount of loans that we're closing in that realm, I think there's just a lot of business that passes loan officers by where they go, well, I can't make it full doc through Fannie Freddie or through VA or through anything like that. Therefore, they don't qualify. There's no options, right? And so one thing to kind of reframe your mindset on is in the spirit of structuring loans and doing things in a way, where, hey, this at first glance isn't a non-QM loan. It's not a bank statement loan. It's not a DSCR loan, but maybe non-QM can solve my issue just with how they're able to structure the deal, right? That I think is a crucial thing to take away from this webinar. And then why partner with us? So, I do want to get into a couple things here. So, obviously we have, some unique programs, right? We've done a ton of webinars on our bridge loan, very unique. We have the ability to do less than, 1 year of self-employment history, reverse 1031 exchanges, right? There's a lot of things that are very niche for us as far as programs go. But above and beyond that, again, you have a, full doc loan, and there's 2 or 3 different non-QM lenders that can maybe take care of that for you by structuring the deal smart. Well, then what's the reason I would send it to LendSure, right? Why would they provide value here? So, I mentioned towards the beginning of the call our ability to grant exceptions, right? Those common sense human decisions. Again, the guidelines for us are more like suggestions, right? We're looking at, do we like the deal? Is it something we think we can get behind? Do we think this person's going to pay us, right? And so, what we have kind of arranged with our investors on the back end and who we sell our loans to, it allows us to do things that literally no other non-QM lender will do in the realm of, granting exceptions based on compensating factors. Our AEs, so Catherine, Tyson here, really all of our AEs are highly trained, highly experienced. You won't find AEs with other companies that are as well versed and well knowledge as ours are in underwriting, in these nitty gritty DTI things, right? Where you call your account executive with most places and they're just like reading off a rate sheet. And well, it says right here that we can do this, right? And they don't really understand how things work under the hood. They really don't have that deeper level knowledge, that subject matter expertise, where they can properly advise you on, hey, this is actually going to be something we're able to do because I'm able to move X, Y, and Z piece into place and structure this in a way that makes sense. So, with the complexity that there is in the upfront pre-approval process, right, in the scrubbing of the loan just from the AE talking to you on the phone and asking the right questions, we're very, very thorough. We're vetting these files up front in the first 24, 48 hours, and we're getting a member of senior management to sign off on that particular deal. So I want to speak to the level of seriousness we have in our pre-approvals. And so Rose, if you'll advance to the next slide here for me, just kind of expanding on that last bullet and giving you a little bit more detail. Right, these pre-approvals that we're doing are really, really rock solid, and it's because we're taking these files in upfront right away from the get-go, and we're getting way more documentation than what most people require. Because when you typically think of a pre-qual, you say, oh yeah, I eyeballed it for 30 minutes and it looks good, right? We're taking this two-day approach to say, hey, we're really pre-underwriting this, and we're putting it in front of somebody who is the senior manager, who is the boss of the underwriter that will eventually get it, right? So if 2 weeks down the line, we've got the LEI, we've got the appraisal order, the underwriter gets it, and they go, well, I don't like this or I don't like that. We go, tough luck, because your boss already approved this file. He already signed off on that, right? I don't care what you think about it. I know that someone with a level of authority higher than you likes this loan and wants to do it, right? So the amount of fallout we have is just so low, so non-existent. I mean, obviously you're gonna have things that come up, appraisal comes in low, you're gonna have things outside of anybody's control. But when it comes to controlling what we can control and saying, hey, the story hasn't significantly changed. We've known upfront all the different core pieces of this, and once we make a commitment, we're saying, hey, we're gonna back that up. We're gonna lean on that. And so, one of the things that loan officers typically love about working with us is just that they're able to take really anything we say to the bank and take it back to their borrowers, and they never have to come back with egg on their face, hat in hand, and say, oh, I'm sorry, I got screwed over. The lender promised me this, and then they didn't deliver it, right? It's like, no, we're on the same team. We're, two sides of the same coin, and we're moving forward here together saying, look, you got to be able to trust me and what I'm telling you in order to communicate that through to your borrower, because you're the face of the transaction, right? It's your name on it, your license on it, and all that. So, if you can trust who you're working with on the non-QM side, and believe me, in the non-QM world, very wishy-washy, right? So many exceptions, these are tough loans we're talking about here, right? These are not cookie cutter loans. And so that even more so highlights the fact that you need to find a non-QM lender you can trust, where, even despite the challenges and despite the difficulties that come with these types of loans, you're working with somebody that is never going to rug pull you, right? They're going to tell you, hey, look, upfront, quick no. Sometimes that's the best thing you can get is a quick no, right? So hopefully that all makes sense. I think obviously the programs, the niche programs are great, but what I value the most about LendSure and what I think a lot of loan officers do is not even that. It's the experience, right? It's hey, when I send a deal to LendSure, I'm sleeping well at night. I'm not ripping my hair out. I know they got it. They're taking care of it, and it's an extension of my conforming business in that I don't have this bad reputation or this crazy fallout in my conforming business. I know Fannie Freddie guidelines, I know Govy guidelines, I know how to do loans, right? And so we're kind of mirroring that for you on the non-QM side and saying, hey, we're going to be exactly how you conduct your business with your conforming clients. We're going to be that for you on the non-QM side and partner with you in that regard. So, it'll take a loan or two, right, where you send it in, you say, all right, I'm giving LendSure a shot, let's see how it goes. And I think you'll see the difference immediately. And, as that trust starts to build, that relationship builds, we, offer all kinds of things as far as trainings for your real estate agents, right? Once you got a great partner in us, hey, let's do a webinar where we're hopping on with your 3-4 best agents or your best office, and we educate them on bridge loans. And we say, hey, look, Mr. Agent, you're not even calling me because you're saying, well, this person needs to sell first before they can buy. It's like, you don't even know what products are out there and what types of things we can do. So because we do bridge loans all day, every day, and we're experts on it, we would then partner with you, to deliver a presentation and help educate the frontline, agents that are out there actually sourcing the deals, looking for the deals, in all the different niche things that we can do, so that they're actually giving you a phone call when something crosses their desk, instead of assuming and saying, oh, well, I know that's not going to work, so I'm not even going to call my LO, right? So, our partnership, we want it to extend far beyond just the basics, and say, hey, look, we want to be somebody that is a cornerstone of your book of business, right? A key piece of helping you grow and fund more loans and make more money. Okay.
Just to go off that really quick, Tanner, a lot of us, we're headquartered here in San Diego, and the CEO works in the office with us every day. He's very interactive. I personally spend a lot of time in his office every week going through, crazy loan structures, approving exceptions, and he really works directly with the investors. So something that I really appreciate about my time at LendSure is the personal training from someone with, 40 plus years of experience like that. It's become really transparent in all of our work here.
Yeah, absolutely.
So you've got all this great information, and now you're excited. You want to go reach out to your referral sources. You want to let your former borrowers know. This is a marketing resource kit. You're going to get this link in the thank you email that you're going to get in about an hour from me, Rose Waldy. That is the link to it. It contains private label flyers and emails and slide decks. For the flyers, you can grab a flyer, put in your logo, put in your contact info, put in your disclaimer, and you can start reaching out to your referral partners right away about these great programs. Now, I'd like to open it up to questions. So if you guys could use the questions tool, type in your questions, and now is the time to get those answered from everybody. I have a question from Nicole. What's the max LTV for a borrower who will buy a new primary residence and plans to retain the departing residence using Zillow Rent to offset? Is 95% ever an option?
It's a good question. So no, the highest we'll go on the non-QM front is 90%. So in a situation like that, they'd have to come up with the 10% down. Depending on their equity position in the departing, we could look at doing some sort of cash out refinance. They obviously want to intend to keep it. If they were intending to sell it, we'd look at our bridge. But if they're intending to keep it, we could look at a cash out refinance, and then still offset with Zillow rents, and then hopefully that would free up some cash for the purchase. But if they already owe 80% or more on that departing, then there's not enough equity there for us to tap into.
Okay. And Jason wants to know, how do I find out who my account executive is at LendSure? Well, you're going to get an email from me, as I mentioned, Rose Waldy, in about an hour. Go ahead and respond to that email, and I will make a personal introduction to your account executive. And if you guys have any other questions that may come up later, please go ahead and respond to that email, and I will be happy to answer for you. Is a recording of this training available in addition to the slide deck? Yes. The email that you're going to be getting in about an hour is going to contain a recording of this webinar. It's going to contain the slide deck, and it's going to contain the private label resource kit. Any other questions? No? Okay, with that, Tanner, any parting words for our audience today?
No, just we appreciate your guys' business, and again, I think it'll only take one loan that you send our way for you to feel the LendSure difference. So I would encourage you to give us a shot.
Awesome, Catherine.
Thank you so much for having me, and have a great rest of your week, everyone.
Awesome, Tyson.
Yeah, I'll echo the sentiments. Thank you very much for your business, for trusting us. We are extremely excited to work with you and hope you got some value out of this.
Awesome. Well, thank you so much, everyone, for joining us today.